doesn't need an orchestra to be a symphony. It doesn't need to compete to be at the top. It doesn't need a single word to say it all.
Sponsored by the Securities and Exchange Commission of Nigeria.
Yomi Adeyemi is a managing director with a unique story. His tenure at the helm of Fortress Capital began at the start of a stock market downturn that left investors and market operators bewildered as they came to grips with an unprecedented bear run.
I took over the management of this company in April 2008, to be specific. And for me, that was really when the market started going down. So obviously, from a business perspective, most of the projections that we made were really not realistic at some point in time. But behind all that, we have a very strong belief that the way the market works in cycle, that obviously the market was going to come back. So, and the only thing we just had to do was to tweak our strategy a bit, that we ensure that, yes, we try to minimize our operational cost, and look out for investments that we believe would give good returns.
The drop in brokerage business led to a focus on increasing operational efficiency and proprietary trading for many of the over 220 stockbroking companies that had to endure one of the longest and sharpest market declines in the history of Nigeria's capital markets. The brokers were a small part of a larger investment community smarting from huge losses.
I joined as the DG of the Securities and Exchange Commission in January of 2010 on the back of total investor apathy. We'd had an unprecedented decline in our markets. We'd hit bottom in February of 2009. The market cap was less than 4 trillion naira at that point in time. A number of investors felt they'd lost their life savings. Some had sold homes and put in the market. We'd had incidences of Ponzi schemes. We'd had a variety of market abuses, share price manipulation, insider dealing, and other forms. And so there was just a total crisis of confidence in our markets, and people were wondering where the apex regulator was at that point in time.
In 2008, the index was at 31,000 at the end of the year, and the market was down 45%. In 2009, the index had dropped from 31,000 in 2008 to 20,000 in 2009. The market dropped 33.78% in 2009. If you add the two together, it gives you the scale of how bad it was. There was a brief rebound in 2010, and the market went up 18.93. But if you know that the market had gone down 45% and 33% and was up 18%, for all practical purposes, it was still way, way down. In 2011, last year, the market was down 16.31. So basically, those 4 years captured the very worst. And what was happening was that people were losing, depending on what stocks they had bought, up to 70% of the value of their stocks. Some lost almost 80%. So basically, you bought something at 100, you were worth 100 naira. You were suddenly worth 20 naira. For those people that, the banks are no more, they've lost they're shut. And you will recall that some of those banks were trading at some crazy price.
The market was clearly very overbought. It was really a bubble market. It was created by far too much liquidity. The reason for the liquidity was that the banks had just consolidated, so they were much larger, and then they come to the market and raised capital themselves. Now they had to spend that capital. And an awful lot of that money, which was leveraged, then went into the stock market. And it took it up to levels that were clearly unsustainable.
Insurance companies were ridiculously hit. Banks were seriously hit. And then investors went from wealth to debt. And you have to think about what the psychological impact of that. One day you're worth 100 million, the next day you're worth negative 80 million. And all this happened in the space of 10 months.
The seeds of the market downturn were sown in the years prior to the 2008 peak.
The market was going up, and so everyone wanted to take part in the market. So you had those who, through the stock exchange, were able to list and also raise money through the stock exchange. And then you had situations where they had a flurry of private placements. It's estimated there were hundreds of private placements done, the lack of liquidity, where for a lot of the people who took part in it, they were promised that there was going to be listing, which some of them had not listed, so the illiquid. Even some of the projections, you look at the financial projections a lot of those companies made, even those that were listed on the exchange, some of the projections were just outlandish. But the market had this confidence in the market, and so it just seemed like it was never going to go down.
In 2007 to early 2008, what we really had was the proverbial bonfire of the vanities. Private placements were, the issuances that were hitting the market were generally lightly regulated, and investors were investing based on nothing more than past experience in other investments that in a lot of times were unrelated, and the level of scrutiny of investments was very low. On the flip side, you had banks that were awash with capital that they had to put to work, and for them it was a no-brainer to do.
Price manipulation. You saw companies that are about to go into the market, showing that share price started moving up. You saw the allegations of insider trading, opaque, lack of transparency within the market, and just brokers selling clients stocks without informing clients, just various kind of infractions, which there seemed to be no regulatory punishment.
A global financial crisis and attempts by the NSE management to stem the tide only added more impetus to the bear run.
It happened to coincide with the foreign markets collapsing, and a lot of international fund managers having to pull out of Nigeria, even though they didn't necessarily want to. Their books were being so hammered offshore that they had to actually sell stocks that they had a profit in. The stock exchange itself did not handle it very well when they started trying to put circuit breakers in place at 1% per day. Those don't work. When the market's going to go down, all they did was extend the pain over 9 months, which could have happened over 2 or 3, and I don't believe the market would have fallen as much had they not had the stock, had they not